Okay, we are about to get going, everybody. Thanks for joining us. So, this is on solid foundations? Question mark. We're talking about the outlook for real estate and its allocation in a portfolio. Right? It's real estate has been an interesting asset class, a popular asset class, always in a robust portfolio in Sri Lanka, because and we'll ask our panel about this. It's been an excellent way to diversify risk, and it is also kept up, if not sometimes exceeded, returns on financial assets that have been available in the past. So we've got a great panel to discuss this with us today. We are live on Zoom. Our Zoom call is full. And if you or a colleague still wants to join this, if a colleague of yours still wants to join this, we are also live on Facebook on both on Economy Next and on Echelon on Facebook. And we are also live on YouTube that is on Echelon. So several ways of joining this call. Already, I think in total we have over 100 people online with us, and the numbers are increasing. Like I said, our Zoom call is full. And today's event is brought to you by or powered by the wonderful people at Capital Twin Peaks. We are grateful for their association with this event and for making this possible. So a shout out to everybody at Capital Twin Peaks. And we've got a stellar panel today. I'll start with the introductions. Let me introduce the panel to you. And I'll start with Chandaka. Chandaka de Soysa is the founder of Acquest. Acquest is a real estate, is one of Sri Lanka's, if not Sri Lanka's leading real estate services company. Chandaka, it's an interesting business because I think it's also a business that's been hugely disrupted by digital, because now potential buyers and potential sellers can, find themselves online, right? How do you, in terms of introducing the company also, how does a real estate services company like Acquest maintain its relevance in an era when buyers and sellers can find them online?
Well, Shamindra, thanks for having me on. For us, this is very, very important. Over the last couple of years, we've been basically trying to focus on bringing in as much technology as possible. And in the next 2 to 3 months, we'll start launching platforms that will help us to put very extensive inventory options, data about the market to enable informed decision-making, not just for home buyers and investors, but also for developers, banks. So we're very focused on that and bringing as much technology in, so we reach a much wider audience using things like virtual walkthroughs, 3D walkthroughs, basically to take a very, very extensive inventory out to a wider market. So we hope to launch these platforms over the next couple of months.
So there is more transparency with price discovery, I suppose.
Yes, and a lot of other market.
Nayana Mawilmada. Nayana is an executive vice president at John Keells Holdings, a company that most of you will know quite easily. He's also the sector head of JKH Property. Nayana, John Keells, is in a bunch of businesses with very recurring regular cash flows, whether it be supermarkets, whether it be running a port operation, or, making food, right? Manufacturing food, or hotels. How does property fit in? Property is gloriously, difficult to, manage cash flows on, right?
Sure. So, of course, it is very different than the other verticals, the other 6 verticals in the business overall. But I think, while it's a little bit lumpier, it also provides us the opportunity for really quite big moonshots, if you will. And that's kind of what we do. However, what we've done over the last couple of years is really So we're the obviously largest developer in Sri Lanka. And we've done typically one at a time in sequence, but now we've gotten into multiple segments where we're parallel processing, which allows some smoothness to the cash flows as well. So we've got 3 big projects in the market right now. Of course, Cinnamon Life, everybody's heard about Cinnamon Life. We've got Trizon. We've also got Victoria Golf and Country Resort, and we just launched that as well. And we've got a whole bunch of other things in the pipeline, which then should allow us a much steadier kind of run. So, we look at this market very, very aggressively, lots of deep analysis. So yeah, we're very, very bullish for the medium to long term.
Excellent. Thanks. Naveen Gunawardane is co-founder and general manager at Lynear Wealth Management. Perhaps generally speaking, of the companies here, the least well-known, Naveen, and I don't think you consider that a problem at all. I'm not suggesting it is, but can you, for us, explain what Lynear Wealth Management does?
Thanks, Shamindra, and thank you very much for having me on this panel. So Lynear is a wealth management firm. We started the operations just over 7 years ago. We have 2 parts to the business: an institutional asset management business where we manage the Sri Lankan investments, which is mainly equities and fixed income for institutions, both local and foreign institutions. And then we also have the second part of the business, which is our multifamily office, where we work with ultra high net worth and families. And in that, we actually go beyond traditional fund management. And even though we are not very well known, we don't advertise. We are quite media shy, as I'm sure you're aware. We rarely come on this sort of things. We are one of the largest players in the equity market at the moment, perhaps the largest private sector investing in the equity markets at the moment.
All right. So just to give everybody a sense about how the conversation today is going to be structured, I will ask each of the 3 in the panel here to present some opening thoughts. Maybe take 2 minutes with it. It's about enough time to present 1 or 2 ideas. That will hopefully form the basis for a conversation. We will speak for about the webinar will last for about an hour, 15 minutes. That's what we plan for it to be. And we'd really love to have your questions. So you can post those questions. If you're on the Zoom call, you can post those questions on the Q&A function here on Zoom. And we have a couple of questions already. Right. And also, if you are on Facebook, do post questions there. I will do my best to pick them out from Facebook too as we go. Right. It makes the greatest sense, Naveen, to ask you to start with opening remarks, because you have the widest, you're the person with the multi-asset class view here, right? And I think 3 asset classes are relevant. The 2 financial assets that we can popularly talk about, that is equity and fixed income, and obviously real estate. Real estate has been part of most people's portfolios in Sri Lanka.
The World Bank is expecting a 5.2% contraction for the global economy. But as I said, it's been a bit of a mixed bag. Within that, you have countries like China, which went into the crisis quite early, had very strict lockdown measures in place, and seems to have bounced back quite strongly as well, a 4.9% expansion in the third quarter. And it's tracking to about a 0.7% in the first 3 quarters. Then you have the US economy, which had a 32% contraction in the second quarter. Now, that was an economy which one could argue was perhaps beginning to slow down before COVID struck. And this is making matters worse. And then you have Sri Lanka. Again, if we cast our minds back to January, February, we had quite a bit of stimulus in the form of massive tax breaks that were given in January. And when we looked at consumer space in particular in February, a lot of the consumer companies were actually seeing year-on-year growth in terms of volumes. So you could argue that the Sri Lankan economy was perhaps an economy that was on the cusp of starting an expansionary mode. And when COVID struck, or more particularly when the lockdown came into effect, what happened was that economy just paused. which is why when the lockdown restrictions were restricted, we actually saw a faster than anticipated recovery in economic activity. You had consumer spending coming back to near last year's levels. Some data shown by Nielsen showed year-on-year growth in June, which perhaps had some pent-up demand, but certainly July numbers were tracking very close to last year's levels. And to me, that's not a surprise. We have certain quirks in our labor market. We have 27% of our labor force in agriculture, and agri is impacted more by the weather, and you could argue that that segment was not severely impacted. We have about 15% in the government sector, which did not have any salary cuts. So in a sense, perhaps no surprising that the economic recovery started much faster. And we've also helped by a much faster than anticipated recovery in exports. Now, if you look at what central banks globally have done in response to COVID, central banks globally, and CBSL was no exception, went through a period of massive monetary easing and quantitative easing. And that has done two things. One, obviously, it has brought interest rates down. If you look at Sri Lanka, the one-year T-bill, which was at 8.45 beginning of the year, is now at 4.99. If you forget yesterday's auction as perhaps an anomaly, you do have, at the same time, quite a bit of money that has been printed. So quite a bit of liquidity has been pumped into the system. And what that has done, in effect, has actually caused a rally in risk assets. So if you take equities as an example, S&P 500, which was down 20%, up to 20% in March, is up about 33% from the March lows. Even in Sri Lanka, the S&P SL20, which was down about 33% going into the market shutdown in March, is actually up about 17.5% from that point onwards. So what that basically means, and I will conclude my opening remarks with that, what that basically means is that investors have had to reassess their asset allocations. So the asset allocations that you had at the beginning of the year are no longer valid. A lot of investors had to basically reassess their allocations and relook at increasing allocation to risk assets. And in the Sri Lankan context, when you talk about risk assets, and that's really equities and real estate. Thank you.
All right, thanks. That's an awesome overview of where we are. Central banks, monetary policy has played a greater role in this transformation post-COVID than any other single instrument, I think. Nayana, can we bring you in? Opening remarks. What would you like to put on the table here?
Sure. So I think for me, there's really a broader question of how will COVID fundamentally impact the real estate markets. I agree with Naveen. Everybody's looking at these reallocations, and real estate is one of those sectors that people certainly will look at in an environment where interest rates are roughly around inflation, really. But the question really is, how is real estate going to change in the short term, and what's the impacts going to be in the medium to long term due to COVID? And when you look at that, of course, you need to disaggregate it a bit into residential, office, retail, and perhaps land. We tend to talk mostly about residential, but there's a question of, okay, in the short term, what I see is, it's very clear that there will be some pressure on yields because rental markets in the residential space have slowed down a little bit because we've had fairly large exodus of expats. And the expats were really keeping the rental market, particularly in the CBD, propped up. So in the short term, we are seeing that. So we are seeing, and that started actually in Easter. After Easter is when this trend started. We're starting to kind of come back, and then things, we got hit again. So the yields, I think, will continue to suffer. And this will be the same, I think, in maybe a lesser way in the office. You see it because the leases tend to be longer term, so people will ride it out, but you are seeing a bit of pressure on that front. And then, of course, retail, again, retail industries hit fairly badly because of tourism being hit, and it's a kind of roll on. So there's pressure on yields. And I think that's going to be a kind of constant in the current environment in the short term. And sales velocities have kind of faltered a little bit to some extent, even though people are looking. So I think in the end of the day, I feel like you're going to have some blood on the streets, if you will. But then again, I think smart investors who really look at this medium to long term and make very calculated kind of decisions for the medium to long term will do very, very well in riding out this current. And I think looking medium to long term, the big question that I get asked a lot is, look, our city is going to fundamentally change. Is everyone going to pack up and go to the suburbs, and Colombo's never going to fly again? And to me, that's like a fundamentally no. That's a ridiculous argument. We can get into it if you want at some point. It's really to me more interesting to think about, okay, how these things will start to nip around the edges, but how will that affect the fundamentals? So if I was to make a forecast, given that, and of course it's maybe dangerous to do a forecast on a public forum, but given where we are on the macros, also given the way we seem to be pivoting on mass transit versus vehicular traffic transport. My sense is, you're not going to see the kinds of gains that I would have expected to see in suburbs now. I think you'll probably see a much bigger rally in the center of the city, and that value will retain until we start to pivot onto mass transit. And if those get activated again, then things will change. COVID, to me, is a blip in time. And the trajectory of a city, 1 year from now, maybe 2 years maximum, this thing is going to be a thing of the past. So I don't think it's going to fundamentally change the way the overall dynamics of the market work, but we can debate that later. That's
all right. That's also an excellent point at which to bring Chandaka in. Chandaka, your opening, you've had a seat on the front lines of seeing how the market has reacted to all of this, right? I'll bring you in for your opening remarks.
So, Shamindra, so what we've seen in the last 3 months to kind of better understand and set the stage for where we are at the moment. If you go back to, say, 2010, 2011, we saw a lot of capital go into the real estate market across the board, central Colombo suburbs, commercial real estate, residential real estate. And we saw that at that time as well, interest rates were very low. We saw capital values and real estate values go up as high as 500% for some types of property. And then the market was overheated in 2016, 2017. And it was, it had to cool off. It couldn't keep going. And for a lot of reasons, uncertainty, political uncertainty, government policy. We had various comments that were made that affected sentiment. You had the Easter bombing, so hotel properties at that time. And gradually we knew that this was going to change. Interest rates came down, people are going to start looking at real estate. So we saw that happen gradually. And as soon as things opened up, we actually saw a lot of transactions happening. Significant number of transactions, interest, intent from people who were kind of very hesitant to commit pre-COVID. So we've, especially when it comes to land transactions, interest in apartments, we've seen a significant, very significant pickup, because the real estate market also had corrected a little in the 2 years, 3 years preceding the outbreak. So that's basically what we've seen, and I expect this trend to keep going if interest rates, as long as interest rates remain at these levels, we are going to see a lot of interest in real estate.
Shamindra, I think you're on mute. Yeah.
Yes. So we've got a few themes emerging here. On the one hand, Chandaka, you're talking about a frothy market that we had in real estate that's now seen somewhat of a correction and rife with opportunity. Nayana is talking about, there is also this debate about the future of the city. How will we live? How will we work in the future? And that surely is going to have a bearing on real estate. Naveen, monetary stimulus has been a theme worldwide, also in Sri Lanka, not as much as everywhere else, but still stimulus is heavy. And I'll bring you in again, Naveen, because there's this sword of Damocles hanging over our heads with how we are going to manage the debt repayments that Sri Lanka has to make in the next few years. And why I'm bringing this up is because this has got a direct bearing on the budget. This has got a direct bearing on interest rates. This has got direct bearing on how macroeconomic policy will be run in this country, right? I don't know if there's an easy answer, but if you were to allocate assets in this climate across the options, fixed income, equity, and real estate, how would you approach this?
That's a very interesting question, Shamindra. I think a lot will depend on the risk appetite of the person that is looking at this allocation, right? So the risk appetite, if you're a low risk appetite person, the allocation that you're going to look at is very different from a high risk appetite person. And when we talk about asset allocations, there are two asset allocations that we need to keep in mind. There is a long-term strategic asset allocation that is very much based on your long-term expectations, and that doesn't matter if whether you're a pension fund or an insurance fund, or whether you're a person. Looking at your long-term expectations and looking at the long-term macro evolution of the country, there has to be a strategic asset allocation. And within that strategic asset allocation, you have tactical allocations. Now, from a tactical allocation point of view, this is perhaps a time where people would be allocating more towards your risk assets, as I said. So that's your equities and your fixed income. Because expectation is that, and I think Chandaka and Nayana are more versed in real estate than I am, but the expectation is certainly that equities will outperform, and I'm assuming the expectation perhaps is that real estate will outperform as well. From an interest rates point of view, I would assume that these interest rates will perhaps remain till the end of the year. We are probably at the bottom of the current interest rate cycle, so we may be going into a rising interest rate environment next year, but that's a different picture altogether. But considering how far interest rate
can, with some level of authority, speak about risk assets besides risk assets, that is equity and fixed income too, I think. How do you view this challenge that Sri Lanka's economy has to face and an investor has to navigate, given the macro challenges that we are
again, I'll mirror a bit of what Naveen says. I think it really depends on the risk appetite of the investor concerned. I think real estate is perhaps, if you pick it, so at the end of the day, the question to me is, you are going to see probably more people moving money out of fixed income into real estate and equities. The question is, how much do you put where, and is real estate going to do better than equities, or vice versa? And I think the easy answer to that maybe is it depends, because it depends on which equities you really pick and which real estate product you really pick, because you could crash and burn in either one. So I think, again, looking at these two, it's really important to look at the fundamentals of a specific investment and see, does this stack up for the medium term, and does that give you what you really want? Generally thinking, if you're not dependent on yield and you have a medium to long term view, real estate tends to do very well, and it tends to be very safe. Not if you invest in some ridiculously speculative project. But generally speaking, real estate, carefully selected, is a very, very safe place to put money to ride out volatility. In a particular in a place where inflation may rise. I'm not really sure. Naveen would be much better at the macros than me. Wherever things go, to ride out. But again, if you're dependent on it for lots of yield, then you're going to be in a little bit more trouble with real estate.
Naveen, I don't know whether your forecast suggests that inflation is going to be a factor that investors will have to deal with in the next few years, right? But can you talk us through that?
Sure.
Inflation and what's the best hedge, right? You are kind of like putting fixed income we are all putting fixed income to a side here because of the very low yields right now. But how do you navigate inflation if that is going to be a factor?
I mean, at the moment, inflation is an issue. Even if you assume that inflation is at that 5% levels, you are now at negative real rates. If you take the T-bills, at bank deposits, you are flirting with negative real rates. So inflation at current levels is actually causing a bit of problems as well. Given the fact that we have import controls in place, I don't see inflation being a huge problem, certainly in the next few months. Expectation is for inflation to be remain at these levels. You might see sudden spikes coming from food inflation, more driven because of supply side shocks as opposed to demand side shocks. So I think we got to disaggregate supply side inflation versus demand side inflation. We may see a bit of supply side shocks coming in, and that driving supply side driven inflation. But from a demand point of view, with import controls in place, I don't see much inflation being rising in the next few months. Next year is a bit of a different story. We have quite a bit of money which has been liquidity that has been pumped in. We know that private sector credit is slowly picking up. And if you then do a relaxation of import controls too quickly, without taking that liquidity out, then that can lead into inflation, and that the whole problems that we had in the past of BOP, etc., can come into the picture again. So we had to be very careful in terms of next year, in terms of how these import restrictions are relaxed and how this liquidity which has been pumped in is actually taken back.
All right, Chandaka, let me bring you in. Now, you talked about the sort of fairly robust demand you have been seeing since, despite the pandemic, since the lockdowns ended, right? Talk to us about
one of their primary concerns at the point they make that the investment decision is not looking at the rental yield. It's primarily driven by owning a hard asset. It's forced saving, it's investing in something they understand. And I would say the large majority of investors are not looking at it at the point they make the investment. It's important to make sure that you're investing in the right type of property with the right developer that has the financial strength to carry the project through and complete it. Project that will have liquidity. So that is important. If you get those aspects right, then rental yields you will achieve decent rental yields. But if there is an oversupply, it would be for a limited period of time. I mean, I don't expect there to be a lot more supply coming in. Some of the projects that are at the early stages may get delayed, may not complete. You're not going to see the amount of supply that is expected to come in. There will be less supply coming in, and it will be delayed. And again, that will be a short-term thing, maybe 2 years, 3 years. So when people look at investing in real estate, it's important to take a medium to long-term view, and that's the view that a lot of investors that we deal with. That's the kind of view they take. So they're not looking at, say, I want a 6% rental yield or a 7% rental yield. Obviously, you have to factor the capital appreciation. So,
but however, rental yields have been declining over the last 2 or 3 years. Have they not in Sri Lanka? In Colombo, let's say?
Not in the last 2 years. And again, it depends what type of property. So I would say certain properties have held their rental yields. Some properties have seen a significant reduction in their rental yields. Again, when you look at rental yield, it's in obviously relation to the value of the property. So if the property was overvalued and has now corrected to what it should be, then obviously in relation to that adjusted value, then the rental yields adjust as well. So it hasn't been a significant drop yet. I anticipate that rental yields will come down. But it's important to look at, again, like Nayana said, making sure that you're investing in the right properties. And it's when it comes to real estate investments, lot of investors tend to generalize on whether it is land and what the value should be, or whether it's apartments. But with the visibility and perspective of the market that I have, there are a large number of options that will give attractive rental yields and also will perform in terms of appreciating in value.
Nayana, can I bring you in on rental yields? What have you seen in the market so far? I mean, this is pre-pandemic I'm talking about. Post-pandemic, there's been a significant exodus of expats, like you mentioned, and that has caused yields to plummet. But pre-pandemic, had you noticed any trends?
Look, I would be cautious about saying causing it to plummet. But I think this trend of expats trickling out, at least from my vantage point, has been gradual since Easter. And it's been acute since COVID. So you see some pressure. As Chandaka said, you see more pressure in maybe the higher value segments than you do in the mid value segments, that tend to be much more expat driven, for example. So it's almost like, if you look at how much your rental pool is correlated to, how much percentage is driven by expats, that percentage being high means you're more exposed to this volatility and you're more likely to see a bit of pressure. But again, I just want to be clear on this. So that doesn't mean it's all doom and gloom. I think this is a short-term phenomenon. And I think it will correct
the interest rate cycle. And as I said earlier, where we are right now is perhaps at the bottom of the current cycle. So we could be looking at a scenario where you have rising interest rates going into next year, perhaps into 2022. Now, and this interest rate cycles is nothing unique to Sri Lanka. If you look at the world, in any economy in the world, people forget that in the US, the 10-year bond was at 15% in the 1980s. The UK 10-year gilts were at 10% in the 1980s. And as a country's economy evolves, while you still have the cycles, the peaks of those cycles gradually start coming down. So if our assumption is that Sri Lanka's economy is going to evolve, we are going to go from this low-income country or low-middle-income country to upper-middle-income country and perhaps into a high-income country, then we should expect that structurally our interest rates should come down. But having said that, as far as the current cycle is concerned, we are probably at the bottom of the current cycle. So if you're a low-risk investor, you may have to take a little bit of a hit, but you can stay in fixed income if you want to.
As long as inflation doesn't get out of control.
Exactly. Yeah.
Right. So I mean that's the I suppose in a way the difference with real estate, that if inflation starts to go a little haywire, you're safer in real estate.
Is that the case? Do you also agree with that view, Naveen? If you were cautious currently and you wanted to hedge against the possibility of an economy that's a little footloose, at least as far as inflation is concerned, because we've got several challenges to deal with in the next few years, maybe this is the safe haven.
Perhaps, actually, I think, again, not all real estate is the same as what Nayana was saying.
Agreed.
Just like you do, just like, even on equities, just like you had to pick your stocks, you have to pick the right real estate asset. And one thing we got to remember, again, if you're looking at an individual investor, most people own a house. So you already have real estate exposure. And when people start looking at their portfolio exposures, what we find is that people forget about the house they own. They start looking at the investment portfolio, but when you're looking at your overall wealth and the composition of that, I think it's very important that you take that into account as well.
Wealth effects are a factor in a very healthy economy, I think, and if indeed real estate is prices will bounce back or will steadily increase in Colombo because of demand shifting for various reasons. The wealth effect can also potentially kick in, particularly if we are at the bottom of a cycle, like you're saying now. Also,
yeah.
right? Can I bring you Nayana and Chandaka in also on this, right? If we are at the bottom of a cycle, as far as interest rates and the economic cycle is concerned, and it is how can you sort of draw parallels between the current supply and I'm particularly talking about high-rise living, about condominiums, right? ability for people to move in and invest in Colombo, and versus the demand you anticipate, right? This is if somebody wants to invest in Colombo, become a homeowner, currently one of the most accessible ways to do that is to get a condo. If you look at the pipeline, how do you think that plays out with anticipated demand right now?
Okay, so if I could go on that first. So this is a question we spend a fair bit of time thinking about, as you might expect. So the question there is, what's going to drive demand in the future, right? And I would almost go a step further to say, what's going to drive primary domestic demand? People spend 1.5 to 2 hours in the morning getting into work. We have CMC with a population of 650,000 people. We have 800,000 people that float in every day, right? And as a result, we have ridiculous amounts of traffic, obviously. So it's really the question is, how many of these people are going to start to move to places where they can recapture more of their life and really move closer to the city? Because my argument would be that, this kind of sprawl of the city is at its peak in a way. Like, you really can't go any further without imploding in a substantial way. The only way you can unleash that is if you have very, very fast ways of getting back and forth. Minus that, you'll have people starting to gravitate closer and closer to the city, which is a huge opportunity, of course, for folks like us who develop apartments in the heart of the city. The key, though, is, can you develop a product, and is there enough product in the market that fits that kind of affordability profile? And that's really the challenge. So between land and construction costs being run away, you need a lot of innovation to get people into them and get ticket sizes within affordability limit. And then there's some innovation required on mortgages. Now, interest rates coming down really helps. If you talk to banks a few years ago, not many were really interested in mortgages. All of a sudden, lots of people are interested in mortgages. I'm talking about the banks. You have this excess liquidity that they need to get out there as well. So there's an opportunity in mortgages, being able to get people this opportunity, and the mortgages will give people access, right? So to me, the fundamental of, look, is Colombo going to remain a city which is an outlier in the region with less than 10% condos, when the rest of the region is like 60, 70, 80% condos in the greater capital region? Absolutely no. It's just a question of time. And it's a question of affordability, and then access to finance. And access to finance, at least for this short period, looks pretty affordable. The problem, I guess, the tempering effect we have now is there's obviously a bit of economic uncertainty with people getting holds on their salaries, and tourism being a big employer, and there being some uncertainty around that. But if that gets restored and we are able to maintain interest rates in a reasonable way, I think the city is going to thrive, because there is no outlet. You can't go any further out. It just starts getting more and more ridiculous. If we pivot completely and embrace a different way, then it'll change. Then you wouldn't have as much upward pressure in the city. It'll be a little bit more moderate. But again, cities don't evolve fast. They take a long time. So schools and employers and all that stuff is not really going to move anytime fast. So I think I'm personally very bullish on cities.
Chandaka, let me bring you in, right? This is about the pipeline for condominiums. Like Nayana says, less than 10% of Colombo's residents live in high-rise buildings, whereas that number is 40, 90% in the rest of Southeast Asia. Even in India, in biggest cities, the number of people, families living in high-rise buildings is very high, much higher than it is in Colombo.
It's like closer to 90%.
Right. So, but how do you reconcile still the pipeline with the demand? This has been a challenge for the market in Colombo for the longest time. Is this crisis or the pandemic going to make it even more challenging to reconcile this? Where we potentially can be as a city in terms of condo living, and obviously the supply and versus the demand?
To be honest, I don't think the pandemic is going to have an impact beyond the fact that it has reduced interest rates to 5.5%, which actually increases demand, and it helps absorb some of the supply. But the growth trajectory of the country, Sri Lankan expatriates coming and buying, foreign investment coming in. So a lot of the developers got a little ahead of themselves in terms of positioning these projects, and also not taking or not giving enough emphasis to understanding the dynamics of the local real estate market, kind of taking a call on where the project or each of these projects should be positioned. So it was too speculative in terms of positioning these projects. So now we are in a situation where it's the well-positioned projects which are basically backed by developers that have the financial strength to actually complete these projects and have more experience in the market, who have products that actually make sense for where demand is. So the current situation is we've got projects which, because they were speculative when these projects were conceptualized, we've got inventory that doesn't really match demand. And now that some of these projects are completed or nearing completion, it becomes obvious, because off-plan, when people are buying it, the buyers as well and investors in the past have not really gone into the detail or understood the market well enough before they made those investment decisions. So that is changing. This is a natural evolution as the market matures. This is just a stage that we would go through, and developers in future will think a lot harder before they kind of ultimately you're selling a product. Something has to be positioned well. It has to cater to an end user, to an occupant. So also thinking of the fact that we're looking at a situation where we've got this inventory that is not well positioned. The way I foresee the next couple of years is that a lot of this inventory will have to get cleared out in the next 18 to 24 months, maybe 30 months. So you're not going to have this inventory sitting on the market for the next 5 years or 6 years, as some people may kind of assume. So I think there'll be a reset in the next 24 months.
Nayana, I'll bring you in. You know, if Colombo is to have as many people, as many families occupying homes in condominium complexes, right? Even to make a slight dent in the market, to take this number from whatever it is, below 10% to 15 or 20%, are the conditions to creating affordable condos for middle-class families? You'd probably need tens of thousands of apartments to change that number from 10 to 15% or 20%, right? How do you also make it, how does Sri Lanka, how does the market, and I'm looking for ideas here, and anybody can pitch in on this, the affordability factor for a middle-class family is still a challenge, right?
Yeah,
it seems to be a unique problem in Sri Lanka, at least from the outside. How do you weigh in on that?
Yeah, so look, it is very challenging to build apartments that are affordable to, say, the upper middle class in the heart of the city. And really, there are two reasons for that. One is land costs are very, very, very high, but really construction costs are extremely high. And our construction costs are much higher than the region. We're higher than Malaysia, for example. And a lot of that is down to taxes on imported goods. I think there's more competition now, international competition in the construction space. So that's less of an issue now, because there actually is very aggressive competition with local contractors and international contractors. But if we go to a more protectionist mode on construction, then again, you're going to see a much higher construction base coming in. So I think those two things make it very difficult. The third thing that makes it difficult is that, but for me, it's not a big deal. For my kids, it's an absolute no-brainer. So there's a cultural transition which allows you to build more efficiently. As society adapts, you can build much more efficiently. So while your per square foot cost may be high, your actual dwelling can be much more efficient, and there you can try to get some efficiency, get to those price tickets, right? But again, it is a challenge. I think one of the biggest challenges is construction cost. I would say that is the number one challenge.
Naveen, we have been discussing things in general terms, right? It depends. We always use that to talk about allocations, or how should you invest, right? So now we're going to talk about your typical middle class or upper middle class family, right? And we're trying to do an asset allocation for them, or one of the biggest assets that any family can come about to have is the house. A substantial portion of their wealth is tied up in housing. It is the biggest asset class in any country, including in Sri Lanka. Equities and bonds, fixed income pale in comparison to the size of the housing stock, right? Do you think conditions in a macroeconomic sense will change enough for middle class or upper middle class families to be able to make that leap? That's been possibly, it's already been achieved in the rest of Southeast Asia. You're on mute.
You're on mute.
I'm going to use the word depends again. So really it depends on the evolution of the country, right? The macro evolution of the country. You could argue that, yes, you're right. Real estate is a big asset. If you look at the overall wealth picture of a typical family, real estate is a big component. The house that they live in is a big component, and that in a sense restricts how much you can put into the other asset classes. But before we start looking at asset classes or the allocations to assets, I think it's important to take a step back and ask a fundamental question, which is, what are your long-term expectations? What are your long-term objectives? And ultimately, the asset allocation that you come up with should be the allocation which allows you to meet those objectives. Now, your objectives may be of a certain state that you might suddenly decide that no asset allocation can allow me to achieve those objectives. And you need to relook at some of those objectives. So typically the starting point of any asset allocation decision is to identify what those objectives are. Once you have those objectives, then you got to ask your question, okay, what do my assets have to yield to meet those objectives? And based on those, and looking at the different expected returns of the different assets that you have that you can play around with, then you come up with your asset allocation. But as you rightly said, the problem in Sri Lanka is that a large component of that will be the house that you live in. And for all practical purposes, that is actually not going to yield you anything, unless of course you sell it and go to another property. And that is a challenge. And that probably will be a challenge going forward as well, at least for the next perhaps 5 to 10 years.
May I chime in quickly, Shamindra?
Sure.
Yeah. So it's interesting. Sri Lanka has about 80% home ownership, very, very high compared to the rest of the world. It's just that we own, the quality of the assets we own and the locations of them are not optimal, right? Across the country. I mean, something like half the houses in Sri Lanka are not plastered, for example. If you look at the census statistics, it's quite clear. So so I think, yeah, Naveen is absolutely right. People buy homes not expecting yield, and you most of the time can't get yield. But it's usually, in most cases, a very large chunk of your home, of your wealth. But the question then becomes, okay, what drives that homeowner decision? And that's where I see the change happening, because it's not like you're getting, lots of homeless middle class people all of a sudden buying houses. It's people who have homes, maybe inherited, maybe whatever, that start to upgrade and look for convenience and lifestyle improvements with rising incomes. And that's the evolution you see. That's the evolution you're already seeing. And that's why you're seeing like a huge upsurge in condominium developments in the immediate suburbs of Colombo. Take it Vellavatta, Dehiwala, Nugegoda, and you see this happening because that's where the affordability sweet spot is right now. It's very clear that as we become more affluent, we're kind of shedding our old lifestyles and going for a more urban lifestyle. It's just, the affordability is a cap. And right now that's where the middle class is really stuck. And if we are able to break the barrier into the city, that will naturally happen, and it's a lifestyle choice. It's not a pure. I feel like it's not a pure financial choice. It's a lifestyle choice, and that's what you have to look at. Like, what's going to be the lifestyle aspiration of the growing.
So we've been talking, Chandaka, about right now about real estate as something that a family may own as part of part of its earnings, as part of its portfolio, a significant part, right? But you may have a sort of view into how the market's functioning, and you talked about the upsurge since the pandemic lockdown ended. What's the sense that you get? Is this being driven by primarily looking for safe harbor from an investment perspective? Or is it families really trying to see how they can take advantage of falling prices?
The demand that we've seen over the last few months is primarily driven by the lower interest rates. And say pre-COVID, mortgage rates were significantly higher. Fixed income rates were significantly higher. So the current surge in demand is primarily because of the fact that either property is more affordable or it is a more attractive asset class at the moment, given that the opportunity cost is a lot lower. So it at the moment is purely driven by the lower interest rates.
And that is by its definition, it's somewhat speculative a bit on real estate.
Not necessarily. I mean, it's just that the 3 years preceding the pandemic, there's a sentiment that there was oversupply and the market had been overheated, prices had gone up. So with interest rates coming down, almost halving in a short period of time, there was pent-up demand. People wanted to invest in real estate, but the fact that there's lack of proper market information or visibility, which held investors back. And obviously with the interest rates coming down, there's obviously more intent and less to hold the investor back from moving into investing in real estate.
Chandaka, can you give us a sense about scale? You talk about post-lockdown burst of interest. Can you put a number on it by any chance?
So in terms of say transacted value that Acquest has done, say over the last or confirmed transactions since post the lockdown, post things opening up in May, we transacted close to 4 billion rupees worth of real estate since say between July, August, and September. And we also aware of a lot of land transactions that have taken place, and this was stagnant for a long period of time. So it's very.
So by way of comparison, is that much higher than what you would have expected to normally have done, or what you did last year?
So I mean, where the real estate market was pre-COVID, there was very little. There's very little. There was interest, but people were very hesitant, and if the interest rates hadn't come down, we wouldn't have seen this pickup. So it would have been fairly slow. Things wouldn't have really changed too much if this hadn't happened and interest rates hadn't come down.
Right, and like we were mentioning previously in the call, real estate or property isn't just one single large monolith. It's this. There's so many factors to consider right there, right? And there's a question from an attendee also. Again, it's about investment properties, particularly those outside of Colombo. They could be country homes in the hillside, lakefront properties, etc. For the potential of rental yields in the future, maybe, and also for their investment value. If you sort of break the market down, and I'm paraphrasing also a question that we have here, is where did you think where did this demand boom come from? Was it in Colombo? Was it outside of town? And what's your sense about how it will play out?
Well, I mean, there is demand across the board at the moment. It's in terms of how things will play out. I expect there to be, a steady demand for land in the short to medium term. I think in the medium term, you'll see demand for apartments increasing, and land prices will probably edge up a little bit. And I expect demand to stay strong for the next. It's difficult to kind of forecast beyond the next 18 months or so, but I expect demand to be fairly robust for a 18 to 24 month period, considering that we've had a very slow period for the last 3 to 3.5 years.
Right, and I'll bring.
Can I just add just a little bit to that, if it's helpful? I think land prices will move depending on the outlook for connectivity to Colombo. Right, Colombo is going to continue to remain like the hub. We might have another hub emerging at some point, but right now it's Colombo. So speed of connectivity to Colombo is going to be the driving factor in kind of differentiating, one piece of land versus another. So locations that have an outlook of in the near future or the medium term future of getting very fast connectivity, whether it's by highway or rail, are going to see a much larger delta than you would in the others.
And I'll bring Naveen in, and let's see if we can have Naveen not use the word depends on this particular answer, right?
Depends on the question.
You're putting me on the spot there, Shamindra.
Okay, so I mean, like everywhere else in the world, we've sort of seen this divergence of what the outlook is for your ordinary family in terms of economics, and how the financial markets have reacted, how asset prices have reacted, particularly financial asset prices, right? But you have Lynear has exposure to a certain segment of clients whose assets it helps manage, right? In these segments, generally speaking, right? If somebody had investable money right now, and you were looking sort of at opportunities in financial assets versus real estate, and you had a fairly large chunk of money to deploy, how would you play it given the prices of financial assets like stocks, where you saw in the second quarter earnings were down more than 50%, but the market, like you said, is up 33%.
And you can't say depends.
Right. So it's a slightly different ballgame there. There you would actually see a slightly higher allocation to risk assets because you can actually do that allocation. Again, I would go back to that earlier point that I made. Ultimately, your asset allocation should really be dependent on your objectives, your long-term objectives, and from those long-term objectives, you should actually come up with a long-term return target. And these are calculations that pension funds and obviously insurance funds do, but these are certainly calculations that individuals should be looking at as well. So based on that, you will do a tactical asset allocation. But to broadly answer your question, Shamindra, I think you're still looking at a high allocation to risk assets. You are looking at a high allocation to equities than you would have perhaps considered early part of the year, and you may be looking at a high allocation to real estate as well. Now, I would prefer equities over real estate, partly because I think I understand that better than real estate, but more importantly because of liquidity factor. If a fundamental assumption is that we are going into a period of rising interest rates, at some point you have to do another shift in asset allocation. So the liquidity then becomes very important. So you can look at an allocation both to real estate and equities, but depending on the person's appetite, that allocation can actually quite vary.
Nayana, I'll bring you in, and really it's open to anybody else on this call too. I mean, we've seen news that possibly the light rail project is off the cards, as in the form that it was, Japanese aid funded. There is also some evidence that similar rail upgrade on the Kalani Valley line may not go ahead as planned. This does not bode well for containing the sprawl that we've seen take place around Colombo over the last few years.
Yeah, so I'm not going to get into the individual specifics of either of those projects, but the bottom line is this, right? We have traffic at volumes that exceed what the roads can handle at this point. We have really no choice but to go to a rail-based mode of transport that is faster and that is more attractive to the aspirations of our people, right? To the middle and the upper middle class. So if we're going to move those volumes, we have to go into mass transit. There's really no other choice. So my bet is eventually these projects will have to be done, whether they're done by the same people, whether they're exactly the same traces, how it's structured may change. But from a kind of urban evolution perspective, you almost have no choice. You have to do it. Because the economic pressures associated with it and the social pressures associated with it will just become too big that you have no choice. You just simply have no choice. So it might stall now, but I feel like it's going to come back at some point, maybe in a different form, because some of these corridors you simply cannot do it in any other way except rail. So.
And you're all now working from home, right?
Yeah.
And what do you think is the long-term impact of the way the pandemic will alter, and how should we start measuring that? Or, in today's numbers, does that factor in? Can we discount today's expectations we may have on the way we work in the future? Nayana, you kind of addressed this when we started off, but Naveen, Chandaka, can I start with one of you? How do you think real estate will react in the future to how we will choose to work?
Shall I go first? Yeah. So
Yeah, go ahead.
when it comes to office space, I think we're already seeing some sectors that can work productively from home. From what I know, are looking to move to working from home for a large percentage of their workforce. So you probably see a reduced demand for commercial office space for that reason. Yeah, so that's given the work culture in Sri Lanka. I don't know whether that is whether that's going to apply to a lot of different industries, but certainly some industries I think will adopt more flexibility with their working arrangements.
I think you will see that mainly in the services sector. Certainly the IT BPO sector, you'll probably see some structural changes there where you're having a lot more people working from home than from office environment. And certainly in some of the more services-oriented companies, you might see that shift as well.
If I may, I think you will. It depends though how. I don't think Sri Lanka will mirror the rest of. Okay, it doesn't even depend really. Okay, Sri Lanka will not mirror the rest of the world so quickly, because it's dependent on how good your connectivity is, right? So there's two angles, right? One is how good is your connectivity to allow uninterrupted high-speed access. That's the second part of it is corporate culture, and of course it varies by sector. The IT BPO sector is probably better geared than the others. The IT is probably better geared than the BPO. Because of the concentration of infrastructure sometimes and the confidentiality requirements and so on required sometimes in BPO. So I think the jury is still out. And my guess again in Sri Lanka is, you can't judge it. We're at the peak of a pandemic or, peak frenzy at this point. You can't judge, you have to kind of see where it's going to stabilize. I think it'll stabilize not as work from home, but let's give people more flexibility. And that will have some impacts, but not catastrophic impacts in terms of distribution of the city.
Okay, I think we'll get to closing remarks after we take this final question, a couple of final questions from the audience out there. There's a question about, and I think Chandaka is best placed to answer this. What is the percentage of apartments in the CBD which are vacant as there is low demand? How can you generate demand for, rental demand potentially for these apartments? And what is the forecast?
In terms of, it was a question for prime apartments or just centrally located?
It just says, let's say Colombo, CBD or thereabouts. It's fairly prime, I suppose.
I would say occupancy is high. If I were to calculate it, guess would be between 80 and 85%. Occupancy it was higher earlier, but say average it out, I would say around 80-85%.
Okay. There's also a question about REITs. I mean, something we've been talking about, for decades, I think, but now there seems to be some concrete action. How will this impact the market? How soon will this, I don't know whether you're qualified potentially to address how soon REITs will be available in Sri Lanka, but can this be a game changer or is it an incremental step?
I think it's in the short term. I think the way the REITs are structured at the moment and the type of assets you'd put into a REIT, not sure that it's going to be very, very attractive from an investment perspective. I think what will happen is they will allow more flexibility with how REITs are managed, and then that will create more opportunity. But just given the current timing and the type of assets that can go into a REIT, don't think the timing is ideal, but I think incrementally they will definitely have an impact, most certainly have an impact on the market, which will allow, it will definitely happen, but the market needs to mature a little more, and you need more assets that make sense to go into a REIT structure. And I think the regulations and the laws will also will evolve, I think, in the next few years.
I think they'll need to evolve.
Yes.
Right now the rules basically allow 100% yielding assets, and yields are low. So it's difficult to make it make sense. But I think REITs offer a glimmer of hope, actually, simply because most people stay out of real estate as an investment beyond their home because of ticket sizes. And REITs will bring that ticket size down, and it will allow a much larger swathe of the population access to real estate returns and, ideally diversified real estate returns. So I think it's a glimmer of hope. It'll need a bit more work, though.
Naveen, can I bring you in on REITs and also ask you to start the closing remarks? First on REITs, this is a great way to diversify a portfolio without concentrating risk on one big asset, right? How excited are you how practically excited are you about REITs at this point? Do you think it will suddenly change the game for you, or it's going to be a long process?
No, I think we've been waiting for REITs for a very long period of time. So it's an asset class that we absolutely need, because that's actually going to broad-base real estate exposure. As Nayana said, one of the stumbling blocks of getting real estate exposure right now, one is ticket size. The second thing is, let's say you go buy a piece of land, what do you do with it? Yep. Maintenance. So there are a lot of practical complications that come with physically buying a real estate asset, which obviously that's not there if you are investing in a REIT, and you also be able to do it with lower ticket sizes. So I think that's an asset class that's absolutely required, and that will get more people exposed to real estate outside of the homes that they live in. I think there's a further challenge right now, if I'm not mistaken, in terms of the tax treatment, especially on stamp duty, which is also making REITs not viable at the moment.
Yeah, on top of a low yield, it makes it almost,
And then, Naveen, can I ask you to start the closing remarks also there?
Yeah, sure. I mean, just as I said at the start, we are living in very interesting times from a global macro point of view. We've seen quite a bit of actions from central banks, which I think was quite justified. And the reason for that is when you're going into a crisis, it's absolutely imperative that you ensure that your financial system is solvent and stable. So pumping in liquidity is something that you had to do. If there was one lesson we learned from 2008, that is that it's liquidity that causes, or lack of liquidity or lack of access to liquidity, which actually brings down financial institutions. But as I said, all of this excess liquidity has driven a quite strong rally in risk assets. And our expectation is that that rally will perhaps go into early part of next year as well. But from an investor point of view, that is causing all investors to relook at the asset allocations and look to see whether they can allocate a bit more into some of these risk assets. And in Sri Lanka, that is equities and fixed income. Sorry, equities and real estate.
Yeah, real estate. Chandaka, can I bring you in for any closing thoughts right now?
So with the visibility that I have and of the real estate market, for me, real estate will definitely outperform fixed income in the short to medium term, given where interest rates are at the moment, even if interest rates move up, but it's absolutely critical. There is a whole range of investment options. It's critical that an investor understands the market dynamics, and there's proper due diligence before they invest. That's absolutely critical, but definitely going to be there is a lot of opportunity given where the other asset classes are at the moment. So that would be the outlook for real estate.
Thank you. And Nayana, closing thoughts.
So, in a way, echoing both, I think given low interest rates, I think it's an interesting time to look at real estate as a way to kind of preserve wealth as well as grow it, because you have some concerns around inflation and riding through that. The other thing I would say is, COVID isn't going to fundamentally change real estate markets in Sri Lanka. We'll survive it and we'll do well. So those with a steady hand and those who pick carefully will do well in real estate in the next few years.
Thank you. Thank you, gentlemen. Thank you for those candid comments and spending your time with us. Also, a big shout out and thank you to Capital Twin Peaks, who partnered Echelon on this Decodes episode. It's been a wonderful chat. We've had 150, close to 200 people, and that is without the YouTube number. I don't see the YouTube number here on the call live, and I'm sure several hundred more people will see this soon. So thank you also for all of you who joined us. I'm sorry, there's one or two last questions that I could not take on. We had already started closing thoughts by then, but we'll try to see if we can get back to you on those. And lastly, but most importantly, thank you, Chandaka. Thank you, Nayana and Naveen. It's been awesome to have you on this call, and thank you for sharing your thoughts on this day. Okay, so
thank you. Thanks. Take care.
Take care, and thank you very much, everybody.
Thanks, guys.
Thank
Take
you.
care. Bye.